All right. Good morning. Good morning. How are you guys today? We're getting ready for the opening bell here in the futures market. We've got a good day today. We're going to go through and we're going to do Trade Miner. All right. Let's not forget about Trade Miner. We forgot about Trade Miner for the last week simply because we've been working so hard on options. And Trade Miner is the tool that we use for seasonal trades. Now, the great thing about Trade Miner is we can do both, right? We can use Trade Miner to trade options. And since we've been trading options this week, this has been options week at Trade Mentors and at Utah Tech University. We are going to trade options using the seasonal nature of markets. So we're going to review our seasonals today, and then we're going to do a little trading with the options, and we're going to review our portfolio. And then I'm also going to show you how our trade turned out yesterday that we put on in the morning session for the futures market. We put on a strangle. Was it a strangle or a straddle? It was a straddle. We put on a straddle, but we put it on two separate tickets. Remember, we didn't just run a traditional straddle. We ran the straddle on two separate tickets, and then we let one pay for the other. Didn't work out the way I'd hoped, but I'm going to show you how it did work out, and you can see if it's something we should do again today. We'll try it again today. We can do it again, all right? If it doesn't work the first time, try it again the second time. When I say it didn't work out, we didn't lose money. We just didn't make as much as we wanted to. So it kind of worked out. So we'll try it again. All right. And I'll show you the charts. I got screen captures of them. I'll show them to you here in just a minute. First thing we want to do, though, is we want to make sure that we're ready for the opening bell. And, speaking of opening bell, here's the software we're using if you want to join along. I'm using the futures version of the software right now. This is Track and Trade. And if you scan that little code over there on the right-hand side, it'll take you to the website for the mobile version, but this is a desktop version of the software, so you need to install it on your desktop. So you really just need to go to trackandtrade.com, download the software that I'm using. This is the stocks version. We're going to use that today too. It's won Stocks and Commodities Reader's Choice Award 7 times. And let's come over here to the economic calendar. This is where I really wanted to come. And we're going to take a look at the economic calendar. So the first thing we want to realize is that this morning we had core PCE price index month over month. So the forecast was 2, the consensus was 2, the previous was 2, and the actual was 1 so core price index month over month. And then we had personal income month over month. Well, that's not good. Core prices went down, but the income went up. Well, personal income. It went down. Forecast 0.3, consensus 0.4, previous was 0.3, it went down to 0.2. So prices went down, core prices went down, but income also went down. Spending, personal spending went down. People stopped not spending as much. So that's not good. Bell ringing. Is the bell ringing? It should be ringing here in about 1 minute. What else do we have? 6:30, we had goods trade balance. We didn't have a forecast on that. Consensus was minus 99. Actual is minus 94. So it's better than it expected. PCE price index month over month. Price index month over month. That looks like a repeat of the same one up here. I'm not sure why that one's in there twice. This is year over year, 6:30. 2.4 to 2.2 price index. So prices didn't go up year over year. Retail in inventories for automobiles went up. So not as many people buying automobiles. Wholesale inventory month over month. Wholesale went up. So more people holding on to their inventory. Michigan, which makes sense because not as many people are buying. Michigan's consumer sentiment comes in at 8 o'clock. That's funny because they oftentimes will turn that one red. And I'm like, why do they turn that one red? It never moves the market. It's not red today. Okay, let's this is not a lot of good news. It's not great news. So let's see what the markets do. Is the bell open? This is the S&P 500 on the opening bell. Let's come up here to the Dow on the 1 minute chart. Let's see what the Dow does. Now, again, remember, the news isn't for us to determine whether the market's going to go up or down, only that the market's going to have some volatility and some moves in it. Let's go to range bar 6. Looks like it wants to trend. Ooh, look at that baby go. Wow. There's the opening bell. It's taking off like a rocket ship to the upside. So it liked some of the things it saw. Liked something. Something it saw it liked. We like to let this go just a little bit because it gets a little crazy on the very first opening bell. But that's the Dow. Let's go look over here. This is the NASDAQ. NASDAQ's not doing too well. It's flushing. Range bar 6. Let's go to 15 to slow it down a little bit. We'll go to range bar 25 to slow that one down. Look, its trend is down. That's more of what I kind of anticipated. But again, it's not for us to determine whether the market's going to go up and down, only that it's going to be active. Because you can see good news and the market goes flushing anyway, or you can see great news or bad news and the market go take off like a rocket ship. You don't know what these big, huge banks and hedge funds have determined whether the market should be higher or lower based on the news that comes out. And they'll make their determination. And then when the market goes, it goes one way or the other. And your job is just to jump on like a tick on a dog's ear and go for a ride. All right. So the NASDAQ's flushing out on that news. The Dow is not. The Dow seems to want to rise on that news. The Russell. Whoa, look at the Russell. Whoa, it's on fire. Think we can get some Russell trades off? It wants to drop again right here. It's moving, man. It's shaking. Let's put one in there just to see if it wants to continue lower. Is it going to do it? Is it going to drop some more or not? Is it done? Oh, it's done. Might go up. We'll give it a shot to the upside. Reverse trade. It doesn't want to go down. It might go up. Let it go. Come on, baby. Rock and roll. Break past those moving averages. There we go. We're getting a little bit up in there. We can move one of these down, take a little profit right there at that green line if it'll break it again. Nope. Took us out. Just made back the money we lost. Well, just break even's not bad. We tried to catch that trend. It's going to go up again, breaking down. Okay, arrow to the downside. Let's see if that wants to go. Nope, not with that arrow. That's trying to go again to the long side. There's drive 1, drive 2, going into second drive. Let's see if it'll break those blue lights and rally, rally, rally. Come on, buddy. Rock and roll. Give us another one of those big, long, green drives. Nope. Says I'm not going to do it. I'm dying. I'm dying here, Lan. I'm dying on the vine. All right. You going to take the short? No. Probably wish I would have. If I don't, you can do it with one contract. It's a reversal, though. I don't want to do it. You can try and take the long. I'm more bullish on this thing. It looks like it wants to go up. It just doesn't want to go up very far without coming back and banging everybody out. Nah, this market's doesn't want to play nice. What about this one? NASDAQ. Ooh, that's too much. Too much. Go to 15. That's a little better. What's it going to do? What's it going to do? Ooh, that would have been a nice trade right there if we'd have taken that little pullback. Just a little bit too slow to grab the button. Coming down to the VWAP. Come on, baby. How far back you going to go? Nope. Nope. I'm going to try the downside again. Nope. Oh, there's 2 times we got whacked. This market doesn't want to go. It'll go. It'll go right when we decide to stop trading. Come on. Stop that. Stop that. Just banging back and forth, not going anywhere, not doing anything. Okay, break below that blue line and drop, drop, drop like a rock. Come on, we need you to move here for us. Not going to go far enough to even get our stop to break even. Come on. It's trying. It's trying. Took the one profit. Backed off anyway. It's a little jumpy right now. I think we'll slow down on this one. It's a little jumpy. A little jumpy. If that one wants to rebound. Markets fall faster than they rise. Usually. Usually. Nope, not on this one. Nope, 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 nope. Not going to do it, Lan. Not going to let you make any money today. I hate trading this early first thing in the morning. The markets are just too jumpy. It's hard to trade this jumpy market. Come on, come on. Pop it up there. Pop it up there. Pop it up there. Go, go, go. Dead. Dow. Doesn't want to go up. Doesn't want to go down. Come on. Can't you do it? Can't you break it? Come on. Little dot said you were going to go. Come on. Let's see you pop, pop, pop like popcorn. Rally, rally, rally. We can't get something going here. We're going to go do options. Okay, let's go do some options. I thought we might get a nice little trend out of here, but we couldn't catch anything. We caught a couple of small ones, but nothing to bring us back up out of the hole. Market's just a little bit too jumpy and a little bit too not trending very well. Well, there it goes on this one. There goes the Russell. We missed it. There's our little shelf, our little pullback right there. Is it going to go again? There's another one right there. No, that's the one that reversed. Hit our yellow dots. Come on. Come on, come on. Nope, it's not going to go. It's not going to go. We tried. Can't say I didn't try. Hurts to try. Can't say I didn't try. Now it's going to go this way. Now watch it go rip and clear up and make all-time new highs, and we'll be sitting on the sidelines. Put them in there. It's like fishing. You got to throw your line in. If you don't throw your line in, you can't catch a big one. You got to break those. No, it's not going to break those lines. It's got to break those lines in the sand. Those are a whole bunch of moving averages. Said, no, Lan, I ain't going to go for you. You keep trading, you're just going to get your hiney handed to you. No, look at it. It's all over the place. Man, it's jumpy. And then it's dead. It's jumpy and then it's dead. It ain't going nowhere for us, guys. All right. Let me show you what we did yesterday. We put on an option strategy, and this is what we did yesterday. Okay. So yesterday we put on a two-legged straddle. So we put it on two separate tickets, which means we just bought a long call and we bought a long put. So it means we make money if the market goes up and we make money if the market goes down. Now remember, when you put on an option, the max amount of money you can lose is the premium you pay for the option, but you have unlimited profit potential. So the idea is that if you do it this way, one will make way more money than the other one loses, right? So you need to have the market move far enough that it'll pay for both the one you bought and the one that you sold. That's a traditional straddle or a traditional strangle. Straddles and strangles are basically the same thing. They just have one has a gap in between them. The straddle has the strangle has the gap. The straddle does not. Okay, so it's just a buy and a call or buy and a put, call and a put. That's all there is. You're buying a call and you're buying a put. So yesterday we did that, but we put them on two separate tickets. So we ran them independently. Both of them can still make max profit, right? But they still have limited loss. So the whole theory here was that we would let one pay for the other. And then once it paid for the other, we put a limit order on there to take the profit off. So then we had it at break even. We had no more expenses. But then if the other one would rebound, the market would turn and rebound and come back up. That would be pure profit. Well, it almost worked like that. It almost worked perfectly, but not quite. Not quite. The first one went down like we anticipated, right? The put went down. It went down $500, and that $125 was when we traded prior to the putting on this strategy. We just made $125 trading options. And then we had the 515. So we put on the 515 against the other 515, and the first 515 came down, dropped, and made $515. And so we took our profit off. Now, what did that do? That covered our costs, right? That covered our costs. And then the second one came back and we lost $410. So we lost $410 on the second one. But look at this dumb thing. This is a lesson for us right here. Look at right at the close. That's where we lost our 414. And the minute it got past the close, it shot all the way back up. We'd have made a whole bunch of money. But because we only bought 0 days till expiration, we didn't still hold that thing overnight. Now, of course, if we'd have held it overnight, we'd have had to pay an extra $100 for the premium. But on the one that the call option that we bought, we lost max profit on it. We lost $410 just before it took off and ran all the way back up, and we would have made a couple $100, $200-300. But no, we didn't get that because we don't still own the stock, right? Or we don't still own the index. We liquidated it at the end of the day because it was just a 0 days till expiration strategy. So we made on the one hand, which is what the strategy was meant to do, right? I mean, it was meant to be a break-even strategy if it didn't make profit. So it paid for itself, $515, and then it lost $410. So overall, we made $100. All right, plus the other $100 that we made. So we made $200 and something yesterday trading options. But we lost 400, and I was hoping that would make another 500. So we would make the 500 to pay for this one, and then we'd make 500. But we only made 100 instead. So can't cry over spilt milk. We still got a little swallow of milk, I guess. So that's okay. So we could put that one on again. We tried a day trade in here, and that went nowhere for us today. So a little disappointed in that one. How come these are? There we go. Look at that dead market. No wonders we couldn't make any money. That market didn't want to go anywhere. It just dead. It had one nice little run right there, and that was about it. That was it. And then the rest of it, we couldn't squeak out a penny. And it was jumpy. Well, over here, NASDAQ, you keep thinking, if I would have kept trading the NASDAQ, we could have made some money and made some of it back. But man alive, it keeps chopping the living crap out of you. It's just choppy. It jumps all over the place. So we slow it down. We go to the range bar 15, and it's just not doing anything. It started to trend a little bit right in here. If you'd have been in that one or you get popped out, you got popped out right there. So that was not even a very good, almost probably couldn't get your stop move to break even. Market's just not going anywhere. Might have been a good market to trade the 777 on. We could have probably done a little scalping. You want to go try that? We got 777 sitting up here, I think. Oh, no, we don't. We got trail ATR. Trail to break even. Let's see. I don't know if this thing's going to. No, this is the ATR. I haven't got 777 set up. All right, that wasn't the goal of what we wanted to do today anyway. We wanted to do options on TradeMiner. Let's go look at our TradeMiner. We'll come back to this. We always like to watch the day trading stuff, but we got our hiney handed to us today on that one. All right, let's come in here. And we're going to look at some TradeMiner options. Now, the first thing I want to do is I want to go back and look at our accounting window. So actually, we closed out so far this year. This since we started trading the putting our portfolio into TradeMiner. Let me get me out of here. When we started putting the portfolio into TradeMiner, this is what we've done. So we started off on August 7th was our first trade, and we closed out $13.95 in Walmart, $7.33 in Apple, $2,000 in Nvidia, $239 in Copart. You can see the dates in here. August 14th, August 19th, Palo Alto, we took $9.82. Lowe's Cause, we took August 20th, we took $13, a big winner there. And then we had Royal Caribbean at $6.29, and then we took our three losers right in a row. Look at that. August 21st, August 23rd, August 27th, three in a row. Safe, Salesforce, Conoco, and United Rental. All three of those were losers. Biggest one was Salesforce. We took a loss on that one. And then Packaging Corp of America, 222. And then Kimberly-Clark, we took out 433. So that was September 4th to September 26th. So that just closed out yesterday. So we come in here. I actually think we closed that one out early. We come in here, portfolio, or maybe it didn't, and I just closed out. We're in here on the portfolio now. This is the portfolio side. And this is what we've got going. So we've got three down here. So this is what we've got trading. First one is started September 24th, so a couple days ago, and it goes till November 7th, and it's already up $706. We're trading the bejesus out of Nvidia. Let's go look at our Nvidia trade. Look at that trade on Nvidia. Look at all these options. Let's just go to that single chart. We're up $144. $144 here, but on the seasonal trade that we got into, we're up $706. So up 6.39%. 6%. That's pretty good. 6%. A lot of people wait an entire year to make 6%. We're up 6% right now on our investment. All right, not on our whole portfolio. So let's come over here. These are all the options. Now, the reason we're down 667 in here is because we bought this leap option. And in fact, we bought three of them, remember, because we're going to do the poor man's covered call, and we're going to teach you how to do that. And to do a poor man's covered call, you have to buy a deep in the money option. So as you can see, oh, that's not the one. Oh, down a little farther. There it is. 357 days. We bought three of these call options clear down here, and we spent $20,000 for it. So for $20,000, we now have $20,000 worth of Nvidia that we're going to hold for 357 days. That cost us a lot of money to put that in there. And the reason it cost us a lot of money was because we had a wide spread, because it's a long time, $357. So they charge you. So it costs us a good $500 to put that on there. So that's why we're down $660. But we got $20,000 against us in there. So we got to make that up. But we're going to make that up selling calls against those options. So that's what this is up here. See how we sold this calls up here? Let me shrink this down a little. Give you some more room. So the idea is that we're going to go ahead and we're going to sell these calls. See these calls right here? Sell three. Well, we're going to receive $720. We're up $210 on it already. So we're going to receive $720 for selling those options, but we don't get that full premium until it hits that purple line. Once it hits that purple line, we get that full $720, and that'll come off of there. All right, and that will pay for that expense that we had, that very first set of options that we put on there. Will pay for that the cost of that NVIDIA long call. Now, NVIDIA rallied yesterday, and it looks like it's pulling back a little bit today. So I want to see NVIDIA rally, obviously, but some days people take profits, and so it pulls back a little bit. I am bullish on NVIDIA, as you can see, but we also have some short positions on NVIDIA, which are these here. See this? This is receive $141 if the market will hit, if we hang on to it until the market hits that purple line. And this one will receive, let's see if we can see. We're going to receive, that's 3 of these we're going to buy. We're going to receive, I can't tell what that one is. We sold that option down here. That little arrow's in the way right there. How can I get that out of the way? There we go. Oh, $378. So we're going to receive $378 for selling that one. Now, remember, when we sell these options, it's like putting a limit order on the stock. So if we sell that, they're going to give us $378 as soon as the market hits that purple line, as long as it stays above that red line. That's really the game you're playing. It's just, you got lines on the screen, and those lines are going to pay off. So it's like, I hate to make the analogy, but it's like going to Vegas and saying, I'm going to draw a line here. I'm going to draw a line here. And if the snaky little thing goes down and touches that, I get this. If the snaky little thing stays up here, I get this. So it's an if-then statement. How many of you are programmers? When you trade, I want you to always think in your brain like a computer programmer. Computer programmers have if-then else statements, right? How many of you are familiar with programming? A software computer program is if this happens, then do this. If the user pushes this button, then do this. If the user pushes this button, then do this. And then you have an else. So it's like, if the user pushes this button, then do this, else do this, right? Do this if he pushes the button. What if he doesn't push the button? Well, then do this. So you have if, then, else. Well, when we trade, we want to trade the exact same way. So we want to always think like a computer programmer when we're trading. If the market does this, then I will do this. Or if the market does this, then do this. If the market does this, then do this. Else do this. All right. So you always have your contingencies. If the market rises, then do this. If the market falls, then do this. If the market goes sideways, then do this. Else do this. Right. If the market goes sideways, then do this. Else do this. If the market goes sideways, do this. Else do this. So this is how you trade. And especially when you're trading options, because options you trade against each other. You sell and you buy options against each other to maximize the profit potential of the market as it moves through that little snaky trend. All right. Now, if the snaky trend is on the way up, we want to do this. Else we're going to do this. If the snaky trend starts to come down, we're going to do this. Else we're going to do that. So your trading strategies when you're trading options are always if, then, else statements. Okay. So that's how you trade options. I want you to always think that in your mind. If the market does this, I'm going to do this, else I'm going to do that. It even was that way when we're trading over here and we got our hiney handed in the day trading stuff. If the market starts to fall, I'm going to get in, else I'm going to get out, right? Or I'm going to put a limit order and take a profit. It's an if, then, else statement. Okay, so let me show you that once more. We put an order in, boom. If the market starts to fall, I'm going to get in. Else, if it continues to fall, I'm going to get out down here to profit. Else, I'm going to get out up here with a loss. If, then, else. If the market falls, I'm going to get in. Then I'm going to take a profit at this level here. Else, I'm going to get out with a loss at this level here. So it's always an if, then, else statement. So you always want to play your if, then, else. All right? And we should be playing then, if, else today, because every single time we did an if profitable and our profitable never came, we always ended up with a loss. So we should have said every time you were going to buy land, you should have sold, and every time you sold land, you should have bought, and every time you got stopped out, you should have got a profit. So we could have played the reversal strategy, and we'd have done a lot better today, I think. Okay, so that's your if, then, else statement. Let's see if that wants to stop us out again and give us another small loss. If, then, else. If, then, else. If the market starts to fall. If I get an arrow, take a short position. Put your limit order there. This is the if, then. If, then, get out. Else, take a loss. If then else. Always have an if then at least, and then an if then else. There we go. Maybe we can get it to pop down there and take our little blue line. Come on. What a dead market. It's not even fun to play. Okay, let's back over here. Okay, so back to NVIDIA. So NVIDIA, we have this NVIDIA right here. This is a sell a call. We're up $228. We have another buy a call. We're up $225. And then we're selling a put. We're up $346. So we've sold some premium, and that's why we're collecting premium. The ones this is a NVIDIA that we sold a put, $16. That one's not paying off yet. Oh, that's this one right here. It will. I'm not too worried about it. 49 days will make $141. Now, remember, if the market turns and comes down, and these options that we've sold down here to collect this premium, 378 or 141, if the market comes down and hits the purple line below the red line, well, we still get our $141, but we also get 100 shares of the stock, which that's not a bad place to own the 100 shares of the stock. And when it's trading at $99 a share, that would end up being about a $9,000 purchase of NVIDIA stock right there. And that's fine. We can afford that. We would be happy to take those shares down there at that level. That would be a good price to own some NVIDIA. So we'd be happy with that. If the market doesn't come down and give us our 100 shares, well, then we're happy with our $141 consolation price. Okay. And that one's the same down here. We've got this one down here. We sold 3 clear down here for $378, and the market would have to come all the way down, clear down to here. And we still get our $378. We get that no matter what. As long as we stay in the market until that purple line, we get that. And it'll show, if it starts to fall, it'll show a loss, but it's just a paper loss. It's a paper dragon loss. It doesn't actually go against you, so you don't have to worry about it. That's just if you were to have sold that at this level, that's the price you would have gotten in your position. So down here, for example, this put option that we sold quantity 1 right here. Is that a put option? Yeah, sell a put. See how we're down 1050? We're not actually down 1050. That 1050 right there, what that's telling us is, had we sold it today instead of when we did, we'd have been able to buy it for $10.50 less, or we would have got $10.50 more in our premium. So we could have got it for $10.50 less, but we didn't. We got it for what we got it at. And that's not going to go against us only if we take it off right now. If we took it off right now, well, then yeah, we're going to lose $10. But we're not going to take it off right now. We're going to either take the shares when the market falls down to our level, or we're going to collect the premium if the price is above our red line. That's all that's going to happen there. Okay, so that's not a loss. It's just ignore that loss on your sold puts, because that's not the side of the market you're trading. You're not going to take that off. You're never going to take your sold put off. You're going to leave it on all the way till expiration, and you're going to take the shares, because if you take the shares, then you can start selling covered calls against it and start making money that way, and just wait for the market to turn around, start to go back up, and then you'll be making profit on your long shares, and you can either liquidate them or you can continue to sell covered calls. And if you sell covered calls against it, you sell a covered call against it until the market goes above your red line once again, and then you sell the shares and you get your premium on the option. That's how it works. So we'll just do it. I know it sounds a little complicated. You're like, I don't get it, Lan. Don't worry about it. Just stick with me. It'll make sense as we keep doing it day after day after day. All right, we'll just keep doing it, and you'll see how it works. It's pretty. It's a pretty safe. I mean, when it comes to options and trading in the financial market, there's no such thing as safe, but it's one of the safest ways of trading. Just selling premium and collecting premium, and then taking the shares and trading the shares until they go back profitable and you sell calls against it. That's all there is to it. It's called the wheel strategy, right? I wrote a whole document on this thing. If you want the documentation for this whole strategy, I wrote it. It's over at, let's go. I'll show you where to get it. You can get it for free. You can get it for free. It's over at, where's my browser? You can get it for free over at Pitt News Magazine. If you want the wheel strategy, that's it right there. The 5 pitfalls of covered calls, how to trade for income. This is what we're doing right here. And you can get that for free if you subscribe to Pitt News Magazine. So you subscribe to Pitt News Magazine, It's $39.95 a year for a whole year. $39.95, 12 issues, and then you can get the 5 pitfalls of covered calls. And in fact, I've even got something better for you. If you're not a subscriber to Pit News Magazine yet, you should already. If you're a subscriber, you already have this. How many of you have read it? This is what we're trading right here. When I'm over here in these options markets trading, this is what I'm trading. I'm trading this strategy that's in this document. How many? I know a bunch of you have it. How many of you have read it? Go read it. That's what we're doing. Okay, go read it. And for those of you who don't have Pit News Magazine, it's $39.95 a year, and you get this covered calls document, and it's tells you how to trade the 5 pitfalls of trading covered calls, what's wrong with it, how to do it, and it's got the other side, of course, selling puts. It's the whole strategy right there. And I want to give you a coupon code slides right here. I give you a coupon code. You can even get Pit News Magazine right now for 50% off. Use that coupon code when you sign up for Pit News Magazine. First full year is only $19.95, $20, and you also get that little booklet over there. You get that little book that I just showed you. You get that little, where is it? Just disappeared on me. Oh, well. There it is. You get that little book right there. Ah! I'm having a hard time here. Let's just forget the little book for now. We talked about it. Go get it. It's over there. All right. All this stuff is documented in that document. You can get it for $19.95 when you subscribe to Pit News Magazine for 1 year. There you go. All right. Let's go to look at the next one. So let's go to Apple and see what Apple's doing. Okay, we sold yesterday. We sold a put on Apple. And so we received $115 in premium. Now, it shows that we're profit loss. We're up $22. All right. And the market on Apple is just kind of dying down here. But if the market falls, that's what that arrow's for. If the market falls all the way down here to below that, it'd have to touch that purple line underneath the red line. Again, if it comes down here and then goes back up, you don't get your shares usually. I mean, there's a chance that they could do it, but most likely not. So if it comes all the way down here, they're going to give you the shares at that red line price. That's where you're going to get your shares. But it's got to touch the purple line underneath the red line. And the purple line's clear out here. The purple line's not going to jump forward. So it's just going to stay right there. And then as the market moves through price and time, if it comes down right there and touches that purple line underneath the red line, you get to keep your money. You get to keep your $115 in premium, but they're also going to give you 100 shares of Apple, which would be a good place to own Apple. You wouldn't feel bad about that. But then you put a covered call against your Apple, and then you start selling covered calls and collecting premium on that. So there you go. So that's just called a cash secured put. We put one on Apple. And here's Chevron. Chevron's coming down. Down. Now, the list that I have here, you'll notice that I have it titled Dividends with Covered Calls. All right, that's the title of my of the stocks that are in this list, because most of them, now some of them are in here for other purposes, just to like the SPY. This is a nice one. It doesn't have a lot. They don't give you a lot of dividends on the S&P, but I want to have the S&P in there because it's so deep. It's got some really nice, juicy options in it. So we like to trade that one anyway. And some of these in here, SPYD, this is a dividend-paying stock, or a dividend-paying ETF. But the problem with it is it's a good dividend-paying ETF, but it doesn't have any volume and open interest on the options, so you can't trade options against it. All right, so that was in there for another purpose. We can delete it out. Same with SVOL. SVOL options suck on SVOL, but it gives good dividends. All right, so let's come down through here and talk about the stocks themselves. So this is Chevron. Chevron gives good dividends, and it's a decent stock. All right. It's a good one to play this strategy on, because you can see it's pretty stable. It goes sideways. It doesn't move a whole lot, but it's a good stock and it pays a good dividend. So you can trade your options on it and put them down there, sell them, collect the premium, and not feel like you're going to get tossed around. Home Depot, same thing. Now I'm not ready to get into Chevron. We could. Well, see, it's way up here. And so we're anticipating a fall in Chevron. I am expecting it to come down. I don't like to sell puts when it's on its way down because then you end up with a paper drag and it looks like you got a big loss. When in reality, what you'll probably do is end up just taking the shares. So I'm going to wait for it to feel like it's turning up. So I want an up arrow, right? I want to wait for this to give me an up arrow. And if it gives me an up arrow, well, as we've seen, and we're day trading, sometimes the arrows suck. Oh, look, there's an arrow that's working out. It's trying to go. There's an arrow that worked out. There's an arrow that worked out. But all these other arrows we got stopped out on, remember? But nonetheless, these are the arrows that we're going to use over here as well. So if we get a down arrow, we don't want to be selling premium because that means the market's on its way down. And that would mean that we'd be more likely to take it'd show a paper loss on the paper, but we'd end up more likely to have to buy the shares. But if you want the shares of Chevron and you want them down here, it's a good way to do it. Come in here. We'll go out 49 days. We're going to sell a put way down here. How much they give us? $100. They'll give us $182 right there. So you can go do that one. And as long as the market stays above that red line, you're going to keep your whole full $172. It's like receiving a dividend, right? $172 dividend. And you're going to have $13,000 invested. So you can do the math. What is that? It's 6.33%. Actually, the computer does the math for you. It's right there. 6.33%. Okay. So 6.33% in 50 days. That's pretty good return on your money. That's, again, a lot of people will wait an entire year to make 6% on their money. But you're going to do it with Chevron. Now, you don't own Chevron. You don't have the shares unless the market comes down and touches the purple line underneath the red line. How many times do I have to say that before you kind of get the understanding? You understand now, right? I understand, Lan. The market comes down and touches the purple line under the red line. I get to keep my $172 plus I get 100 shares of Chevron, which at this point, Chevron would be trading at $135 a share. So that'd be $13,500 of Chevron I would own, and I'd have to have $13,500 in my account, free and available on buying power to be able to put that option on to say that I want to buy the 100 shares at that price. If I don't get my 100 shares at that price, the market doesn't come down and touch that purple line under the red line, then I get my consolation prize of $175, which is averaged to be 6.36% return on your money in only 49 days. So that's not bad anyway. Okay. It's not bad anyway. So should we do that? Yeah, let's go ahead and do it. Why not? Let's go in here. We're going to put one on. We're going to okay, we got the bid and the ask. The ask is 169. The ask is 182. The bid is 169. Let's look over here. The volume is 13 and the open interest is 2,418. Our spread is $13. Oh, that kind of sucks. If I was in the real market, I would try and get it for $10. Get them to give me $3 off, or even more. I might try to get them to give me $4 or $5 off. The volume is low. It's at only 13. Nobody's trading these options today. But look at the open interest is 2,418. That's good. But the volume is low. Okay, so we're going to, if we were in the real money account, we'd come down here and we'd start our bid. Let's see, we better put it back on because it's changed. We're going to sell this one. And it's 175 is the midpoint. That's where we would start. You could even start a little lower, go to 174. Now, the way you do this is you come in here and you say, okay, they're asking 180. The bid is 169. Now I'm selling, I'm not buying. So I have to go to the bid, not the ask. And so if I go up, let's go to 176, above 173. 167 is where we have to go to. So I think we're going to do this, okay? Sometimes I get these numbers reversed too. So we're going to go edit, and then we're saying, nope, they're not going to take it. We're going to go 167, I think. 167, because we're selling, we're not buying. So we're going to come down here. I'm going the wrong direction. 173, we're going to go to 170. Place the order. Did they take it? No. We're going to right click on it, say edit, and we're going to do it again. 173, we're going to go to 168. Are they going to take it at 168? Try it. No, they didn't take it at 168. So we're going to put it right on 167. Are they going to take it? They did. Okay, they took it at 167. Okay, so if you're selling, you have to go to the bid. If you're buying, because you're the one, right? You're trying to offer it, trying to get somebody to buy it. They're trying to get somebody to buy it from you. You're trying to get somebody to sell it to you is what you're trying to do, trying to give you the money, right? Get them to buy it from you. So you have to bid it. So on the ask side, that's if you're buying, then you have to offer what somebody else is asking. But if you're selling, then you go to the bid side. So I know it gets a little confusing sometimes whether you're buying or selling, which side of the market you're on. Are you bidding or are you asking? So that's why in track and trade over here, we renamed these lines. You see over here. Oh, I turned those off, I think. Yeah, sometimes. Oh, there they are. See, they say buy and sell. Makes it easier for you to understand which side you're on. Buy and sell instead of bid and ask. So sometimes it gets, but that's what it is, bid and ask. So if you're selling, you're at the bid. If you're buying, you have to go to the ask. So this is now, we just received $167, and we can now actually go spend that money if we wanted to. We could go buy another option with it. Or like those guys on YouTube do that like to show off, you could go buy yourself a nice dinner because you just made $167, and you're going to get that money no matter what. The only difference is that if the market stays above here, then you don't take the shares. If the market comes down here and touches the purple line and the red line, well, then you get the shares at the red line's price. And so if it comes way down here, then yeah, you're going to show a loss on your shares because you're going to get the shares assigned to you at this price, but the market's trading at this price. So your shares are going to be down in value. That's how it works. And then you're just going to wait for the market to turn around and go back up above your red line. And while you wait for that, you sell another call up here. You sell a call option and you collect the premium on that one. So that's pretty cool. That's called a covered call. And we haven't had to do that yet because we haven't been assigned any shares yet. We just keep collecting our premium. All right. So let's go, and we're going to come over here to Home Depot. And Home Depot, we already did this. So we put this one here. We sold 49 days, and we collected $141. And in 49 days, if the market falls all the way down there and touches that purple line under the red line, we're going to buy 100 shares of Home Depot. If Home Depot doesn't fall all the way down to that level, then we're just going to get our $141 and go spend it on our sweethearts, right? That's what we're going to do with all our money. We're going to go spend it on our sweethearts. We always toast to our wives and our girlfriends, right? May they never meet. What was that movie? That was a movie's line. I didn't make it up. That was a line in a movie. Okay, IBM International Business Machines. So IBM's going straight up, up and away. What do we want to do with IBM? How are we going to make money on IBM? I would like to see IBM pull back. I want to see IBM pull back. Let's put a Fibonacci ruler. We don't know when it's going to turn and start to rally once again. That's what we'd like to see. We'd like to see one of those in IBM. And if it does that, we could start selling some premium down here. Wait for it to pull back. This is what I like to do. Okay, the best time to buy these premiums when this thing pulls back and you start getting these indicators down here in the green zone, like right in here. See this? Right here. That's where I like to actually buy these things. So if this thing pulls back like that and this starts to go green, then I like to look at the MACD. Okay, and then I look at the MACD, and if it starts to turn red to green right there, or yeah, red to green and then red to green, that's where I like to put these options on so that I have a better chance of just collecting the premium and not getting assigned the shares. I mean, it's not bad to have the shares because then you get the NAV too, the net asset value, right? So it's actually better to have the shares because you're going to make the net asset value because you're like, well, if you do a covered call, you make the money on the rise of the market between where you got in and where the covered call's at. You get that profit in there too, as well as the premium. If you just have the money sitting in your account and it's tied up with these put options, well, you're making the dividend, right, or the premium on the option, but you're not making any NAV. You're not making the net asset value. That's why a covered call is better than a naked put. But people like to do the naked puts. but you don't get the net asset value of the option, right? Or the net asset value of the underlying stock if you're just doing if you're just doing puts. That's why we can come in here, and I don't want to buy the I don't want to put on a a leap. I don't want to put on a leap on here. We don't want to put on a leap because if we put on a leap and then the market falls, which I'm anticipating, we get some kind of a profit taking pullback in here, even if it's small, right? So if we look at this, we got drive 1, drive 2, drive 3, drive 4. We got a little reset right here. A little reset right here. So if that's a reset, it wasn't a big enough reset to really call it a reset. That would be drive 1, drive 2 in our 3-drive pattern. But we only got, if you want to call this one back here, drive 1, drive 2, drive 3. So there was your lowest point. We have to take that into consideration. So there's your lowest point. So that's it. Okay, so it is a 3-drive pattern. So we got 3 drives, drive 1, drive 2, drive 3. Then we got our reset, our pullback, and we just didn't get the ABC. So it didn't break lower. So this market just had too much strength, didn't give us the ABC. We needed to have it come down, pull back, give us that Fibonacci bow tie, and then turn around and start making the next drive up. It didn't do that, but it started making the next drive up anyway. So we are in the second drive. So if we're going to come in and look at this from a probabilities standpoint, which we always should, right? Yesterday I told you count, measure, setup, trigger, follow through. The most important thing was to count and do the accumulation distribution model, and that's what this is. That's what that Elliott wave stuff is, and the probabilities of the market rising and falling. We're in the second drive. We're in the second drive of this next drive pattern, 3-drive pattern. So we're looking for drive 1, drive 2. I would like to see a little pullback, and then that should pull this back. I don't know if it'll come back enough to go into the green. If it does, if it comes into the green, we could put on a leap, and we could go with a poor man's covered call. I'm just not ready to pull the trigger on this one because I mean, if it keeps going up, great. Or you could say, well, I want to buy the shares land. If you're going to put on a poor man's covered call, take advantage of the opportunity that this thing might come back and we'll make some money on it while we wait. Okay, well, let's do that. 21 days isn't enough. Well, let's see. Maybe it is. Nah, see, it's not enough. We want it down here, and that's only $27. So 21 days isn't enough. We're going to have to wait longer than that. So let's come down here. But Lan, you said it was all the same. I know on the bell curve, it's all the same, but I want less commissions, less fees. There's $300. If we're willing to wait 50 days, 49 days, we can make $200 down here. Up there, we can make $300. 300, 200. Where do you think the market's going to come down? If the market comes down, do you want to buy some IBM shares here and get paid $200? Now, remember, you're going to have to put in $19,000 in cash to buy the IBM shares. So we have to have $19,000 sitting in our account. We have buying power over here of $75,000. So we got lots of money. We got lots of money to do this with. Receive $205. If we did that, we'd receive $205, but we'd receive our shares. And instead of buying a leap for our covered calls, we just buy some shares and do it that way. If we were to buy a leap, though, let's price out a leap. If we come in here, now we're not buying the leap right now because the market's too high. I want to buy the leap when this little indicator right here is in the green. All right, when that little indicator is in the green, that's when you want to buy your leaps. But we're way up here. That's why we don't want to buy no leaps right here. Don't want to buy no leaps here. But let's go price one out and see what it would cost. How much would a leap cost? If we went out to 357 days and we bought it deep in the money, let's go all the way down to a delta of 90. It cost us $7,000. So if we bought that one, that would be our leap. But see, the problem with buying that right now and saying, well, let's buy it and start selling some covered calls. Problem is, covered calls, it'd be a good place to start selling covered calls because we're way up high and we could sell them way up high, right? We could sell some covered calls way up here. Let's go price those out just for fun. Let's say we're going to do 49 days on that one and we're going to sell some up here. So we sell that. See how high we could go? Way up there. Way up there. When they'd give us $258 to sell that call up there against our against our leap. So we could get that. And the market to get that would have to go up, and we would make, right, on our leap at a delta of 90, we'd make nearly $2,000 on the leap if it went up there, and we'd get $258 here, and then they'd want to take the leap away, but we don't want to take the leap away. So what we would do is if this thing started getting close and was actually all the way up here and was going to touch that purple line above our red line, what we would do is we would roll that one out. We'd roll it up, take our profits and roll it out. But that's what we would do. That's what we would do. Because if you're going to do a poor man's covered call, you don't want to ever lose your covered call. I mean, you don't want to lose your leap. So if you have the shares, it's okay for them to take the shares away because you get to sell the shares for a $2,000 profit. So you get your shares for $2,000 and you get your $261. So the highest profit you can make is if the market will close, touch that purple line above your red line. That way you get your max profit. That's max profit. A lot of people tell you don't want the market to do that. That's a fallacy. When you're trading covered calls, you want that thing to go up there. You want them to take that away. You want them to exercise that thing. Please exercise me. I want to get exercised because then I get the premium. I get all the profit from the shares that went up there, and I get the premium from the option. So please exercise me. I want to get exercised. Most people will tell you that covered calls, anybody who tells you that covered calls is a bearish strategy, change the channel. Don't watch those guys anymore because they don't know what they're doing. If they think that covered calls is a bearish strategy that you should only put it on when the markets are falling, change the channel because they don't know what they're talking about. They don't know how to trade covered calls. That's not how it is. You want that market to go up because you own the shares. That's where you make $2,000. Which would you rather have, $2,000 or $270? Which would you prefer? So anybody who's going to tell you, oh, covered calls is a bearish strategy, that's BS. Because if the market goes down, you're going to lose a ton of money on your shares, right? Also that you can make $270 on your option. But you're going to make the $270 on your option anyway. You get that $270 no matter what. Even if they exercise you, you still get the $270. So why would you want the market to go down? You wouldn't. So if you ever go watch a YouTube channel on covered calls and they say, oh, covered calls is a bearish strategy, you want the market to fall when you put on a covered call, change the channel. Guys doesn't know what he's talking about. All right. So don't listen to him. Okay. We're not going to do anything on here, though. We're not going to do this. Oh, did I just liquidate my position? Did I have a position? Did I accidentally just close that position out? Close today chart. No, I guess I didn't have it. Okay, we're going to do it though. We're going to put one on. We're going to come in here and we're going to buy some IBM if they'll sell it to us at this price. So we're going to sell a put right here, $200. So if they'll sell us some IBM at this price, we're going to buy it. What if they sold us some IBM at this price down here? We'd really want that. That's only $64, so it's not worth it. $133 is worth it though, but then we'd have to buy, that's really close. Then we have to buy, we could make 203 and 103, but then we'd have to buy 200 shares of IBM. I don't want 200 shares of IBM. We're just going to do right here. We'll buy 100 shares of IBM right here if it'll fall, which I think there's a good chance it might. We're up here we might have a pullback and then a rally. But if it pulls back all the way down in there, then we'll buy these IBM shares. All right, let's do that. Let's do that. So we're going to go ahead, and again, we're selling, so we have to go to the bid. Now, the way we're going to do this in the real market, we're going to do it in the demo. We're going to have to pay the full bid. We know that because that's just the way they do it in the demo account. But if you're going to do it in the real money, let's do it as if we're in the real money. So we're going to come in here. We're going to start at 202, and we can actually go to 203. See, we're going to try and get them to give us better than that. That's the spread. Oh, we got to check volume and open interest. Again, we're in that same situation. I hate this. I hate it where we have lots of open interest and almost no volume. Just means nobody's trading them today, but they've been trading them a lot. Oh, wait a second. Look at the spread. The spread is 70. Oh, it says it's $70, but up here it says it's $1. If we could get it for, let's replace that. That's a call. That's why we got to go to the puts. Sell. Okay. Oh, see, it's $5. and volume's only 37. Open interest. Let's go up one. Let's go up to this one that's got 2,000. Volume. Well, we're early in the morning, so they haven't had time to trade it much. They got 58, but we got 2,000 on the. This is the big number right here, $23. I don't want to pay $23 against our $293. $293 is what we'd collect, but we'd have to pay $23 on the spread. And remember, you have to pay it on the way in and on the way out. So look, the spread we got, if we can do it midpoint, we could get it for $12, and that's fair. We want to get it for, let's see if we can get it for $10. We're going to go in here and we're going to offer them $10 spread to give us the $293. So we're going to offer them a spread. So you place your order and you say, are you going to give it to me? Come on, guys, give it to me. Come on and play with me. And they're going to say, no, Lan, that's not a good deal for me. I ain't going to do that. You're like, oh, come on. I want to buy me some pigs, and I don't want to pay a big wide spread. Come on, give it to me. So you wait a few seconds like this, right, in the real money account, and they're like, no, it's not going to go. And you're like, okay. All right. Now you could just leave it there, and eventually it might get filled, right? You could leave it there all day, and it might get filled. But what would have to happen for it to get filled at that level? Well, the market would have to fall. So if the market fell, then you might get your thing, but then the value of your option is going to go down too. So you have to take that into consideration. Well, I could leave it there all day and it'll eventually get filled and I'll save my $3. Yeah, but then the premium that you're going to receive is going to go down to like, by $10. So you just as well just get her while the getting is good. So we're going to come in here and then you right click on it and you say edit and it brings it back up over here. And now you can bid again. Now you come in and you say, okay, 293 was the bid. I was trying to get them to go all the way to $10. They're not going to do it. Let's see if they'll do it for, you got to go this way. Will they give me, and that's how you know whether to go to the ask of the bid if you get a little bit confused. Just always have to give them more money. That's how you know if you're going in the right direction. If it costs you more money, you're going in the right direction. All right. So let's offer them $12 spread. All right, to give me my 295. They want $12 of my 295. That's what they're saying. They're saying, if you want to get your $295, you got to give me $12 to do it. Okay, let's see if they'll do it. Hit the modify the order, and you wait. You don't have to wait very long. Just wait a couple of minutes, or a couple. I usually wait. I'm an A-type personality, so I don't have a lot of time. I don't have a lot of patience for it. It's like if they don't fill it in the first 10, 15 seconds, I'm like, okay, it's not like it's a person. It's not like it's a man sitting there going, "Oh, Land's trying to sell a put, and he wants $293. I want to if he'll give me $1 more out of his pocket for this thing." That's not what it is. It's a computer that's sitting on the other side, and it's got a mathematical formula that says this is my boundary, and this is where I'm able to buy and sell at within this boundary. And if Land will put his order inside that boundary, I'll take his position. So what I'm trying to do by bidding up $1 at a time, I'm trying to find the very edge of his boundary. Because if I just jump right into the middle of his boundary, well, he's going to give it to me, but he would have actually given it to me maybe a little bit less if I would have just kind of inched into his boundary. As soon as I get the edge of his boundary, he's a computer system. He's going to fill it. All right. It's a computer. It's not a man sitting on the other side. So all you have to do is find out what the boundaries are of the high boundary or the low boundary of their bid-ask spread, and you just try to move into that boundary. So that's why you don't have to sit here and wait for an hour, because that boundary will move back and forth if the market moves back and forth. If the market doesn't move, the boundary will sit still, and you have to come to the boundary, if that makes sense. I don't know if that makes sense, but that's how it works. So we're going to come in here, and we're going to right-click on the little icon again, come in here, and we're just going to keep moving it up $1, hit OK. Are we within his boundary? No. Okay, let's do it again. Going to come in here, edit. We're going to add another $1. See if he'll do it the other direction. Go to $13. Will he take $13? Modify. No. Okay, we're still outside his boundary. So we got to go one more into his boundary. And you can sit here and play this if you want to all the way. I mean, it depends on how fast the market's moving. If the market's moving around a lot, you might want to not sit there and play the boundary. Just try to get in there and get your order, because the value of your premium is going to increase or decrease based on the movement of the market. And if the market's moving, you don't have all this time to sit here and do this. You might want to just dump it in there and get your, pay that extra couple bucks, because you're losing it in the premium. So we're going to come over here, edit again, and then you're going to go find the boundary, go to one, the spread is 14. Down here it says the spread's 18 right there. So spread is 10. 82. Spread is 12. We're going to go all the way to 282 is what we have to go to. 282 to get that thing within the demo boundary. And that's $18. And you can see that reflected down here in the spread. But remember, in the real money, the boundary may be the bid and the ask, but they'll put that boundary in a little bit, and they'll give you better prices. So you can come in here, and we're going to go ahead and hit modify, and it should give it that time. Okay, we got one. We hit the boundary. All right, we got inside the boundary, and we got our order filled. So there it is. We got our option. And that's a good little lesson. That's a good little lesson for you to learn how that pig auction works. I call it the pig auction because most people have been to pig auctions. Maybe most people haven't been to pig auctions. Why do I think most people have been to pig auctions? Because if you haven't been to pig auctions, you can't call yourself an American. You got to go to at least one pig auction in your life. All right. Pigs, cows, sheep, goats, whatever. Go to an auction. Go down to the fairgrounds. Most towns in America have a fairground. And every year they'll have, if they're not having, you don't have to go to a commercial auction. They have auctions for the kids who raise animals. Most even the big cities like Chicago has a fairgrounds, and they have the FHA, I think they call it FHA. And the FHA kids raise pigs, raise cows, raise sheep, and they take their cows, pigs, and sheeps to the FHA, and they show them off, right? Oh, look at how pretty my pig is. Oh, look how pretty my cow is. Oh, look how pretty my sheep is. And so you go and, oh, you pet the sheep. Oh, it's a pretty sheep. Oh, yeah, that's beautiful sheep. Oh, that's a pretty pig. Oh, look how big and fat that pig is. That makes some great bacon. Oh, really nice. And then they auction them off, and they do a real auction. If you've never been to one of those, you can't call yourself a true American. You got to go to a pig auction. It's the most fun thing in the world to watch them auction pigs and sheep and goats and cows. They auction them off. And then these kids raise these cows. They raise these sheep. They raise these pigs. They become their friends, their pals, their little buddies, their little friends, their pets. And then they take them to the pig auction, and they auction them off. And the guy who buys them goes and turns them into bacon. It's fun. All right, it's fun. Let's go to Johnson & Johnson. Johnson & Johnson is fun. Why? Because they got high dividends and they got high premiums on their options. So you can come in here and you can make a little extra money. That's how it's all about. And then you can go buy you a pig. You can go to the auction and buy the pig and get some bacon. All right, here we go. We just sold this one down here. So we're going to buy some Johnson & Johnson if the market will fall to that purple line under the red line. We'll buy ourselves some Johnson & Johnson. It's going to cost us $15,000 because we're at the $150 put. So $15,000, they're going to have to set that aside in our account. It's a cash secured put. Lan, what if I don't have $15,000? Well, I'm glad you asked. We can do something. Let's do it over here on JP Morgan because we don't have one. Let's say that in JP Morgan, we want to buy some shares of JP Morgan down here, but that would cost us $19,000. All right. But I want to participate in this, Lan. I want to do what you're doing. But the problem is I don't have $19,000 in my account. I've only got $5,000 in there. Well, there's two things you can do. First of all, you can go find a stock that's trading so that the $5,000 will cover the option, right? So a $50 share would be $5,000. So you could do that. So you have to go find a stock that's trading at $50, and you're just going to have smaller premiums. It's going to get eaten up by the spread. So you have to be very careful. Make sure you have a tight spread. Don't get chewed up in spreads, but you're going to be able to do it with a $50 per share option with a $5,000, right? You can go do that, cash secured. But there's a little trick you can do here. Watch this little trick. We're going to come in here, and again, this is trading at $197, $191 at this red line, $190. So you'd have to have $19,000 in your account to sell the option. Let's get rid of this red line. And so now we're going to buy an option right here. Let's go see. We're going to go out 50 days, 49 days, and we're going to sell a put. We're going to drag that in there right underneath there, just like that. We're going to make $189 if we sell that. $189, and we're going to have to buy the shares right there, right? We're going to have to buy the shares if it falls below our line. But those shares are going to cost us $19,000, and they're going to require us to have 3,000. The margin requirement is only $3,380. So you could actually do this with your $5,000 account. Okay? Because look, the margin requirement, because you're on margin, you can do this in a cash account too, but then you have to have the full cash amount. But this is on margin. And so it's $3,380 is all you have to put that on there. But you're still going to have to pay. You're still going to have the money to buy it, right? You're still going to have $19,000 in your account if you let that thing go to expiration, and then you're going to play the other side. You're going to play the covered call side. You're going to own the shares and then play the covered call side. This is not owning the shares, and your cash is sitting over here. The problem with this strategy is just doing a bunch of, if you just say, well, Lan, I'm not going to ever own the shares. All I'm going to do is I'm just going to sell a whole bunch of cash secured puts. Well, the problem with that is that the money that you've got, the $19,000, is just sitting over there in your account. It's not earning anything. That's why the covered calls are better. I think I mentioned that earlier. But here's another little trick you can do. Watch this. We can come down here and we can buy a put option. Watch, I'm going to buy a put option. Okay, so I'm going to sell a put option. And down here, I'm going to buy a put option. Now, it's going to cost me some money. See that? If I buy this one. Now, watch what happens to the margin amount over there. Watch the margin amount over in the little calculator. When I click that button, boom, it goes down to $1,500. It dropped in half. So now I only have to have $1,500 in my account to put this on. But I have to pay him $70 to do that. All right. I'm going to buy this. It's an insurance policy that if the market falls too far, then they're not worried. The exchange isn't worried that you're going to go to max loss, right? Max loss is, of course, the JP Morgan could go out of business and they could go to zero and you'd owe them max loss. But the chances of JP Morgan going out of business, well, okay, that was a dumb statement. All these banks are having problems right now. Maybe JP Morgan will go out of business. If JP Morgan goes out of business, though, we got a lot bigger problems than just our little option over here. All right, but this is what that's protecting against. It's protecting against JP Morgan falling all the way down to $175 a share, which it could do. I mean, Putin's out there. You got to take him into consideration with his itchy finger. Fortunately, we've been poking that bear pretty darn hard with some hot sticks, and fortunately, he's not had an itchy finger because we keep poking that bear with a hot stick, and I don't know why in the hell he hasn't punched his little red button and told us to knock it off. I don't like to get political, but I sure hate the fact that we keep poking that bear. I wish we wouldn't do that, but nonetheless, we're poking the bear pretty hard right now with a red hot poker, and he's a little pissed. So could JP Morgan fall but of course, you know what? If Putin pushes the red button, it doesn't matter what we're doing here. It doesn't matter. So don't worry about it. Don't say, well, I'm not going to take this trade because Putin might push the red button. Because if he pushes the red button, doesn't matter if you trade it anyway. All right. It all doesn't matter at that point anyway. So just keep doing it and hope that he doesn't push the red button, and hope that our leaders stop poking the damn bear. That's what I wish they'd do. Stop poking the damn bear with red hot pokers. But they keep poking the damn bear with red hot pokers. Oh, I just swore. Now I got to go to YouTube confession. But that's a strategy you could do. Let's put that on. Let's go ahead and put that on. All right. We're going to put that on. It drops our margin down to $1,500. Now we don't make nearly as much money because we have to pay that insurance policy of $70. And that $70 comes out of our $189. But now we don't have to have as much money taken out of our account. We're trading on margin. If you're not trading on margin, you have to have the full premium in there. All right. But when you trade on margin, you don't have to have the full premium. They let you do it with a little bit less. So we're going to put that insurance premium in there. Now we're going to come in here. And what I've done is I've reduced the cost by pulling it way out here, but I have less insurance at $70. If I push it closer, it's going to cost me more money. Look at that, $134. But notice that the return on risk goes up. It goes up to 11%. But that's because I have a smaller margin. Margin is only $500. So the return on the risk is $11, and I only receive $56. So $56 against my margin amount of $500 is an 11% return. That's pretty damn good, 11% return, but it's only $56. Okay, well, if you want to do that, do 5 of them. Now you got 5 of them. You're up to your margin requirement is 2,500. Remember, they're going to margin you at max loss, $2,500. You're going to receive $280, which is 11% return on your money. But look at where you're at. You got an 86%, 96. You got an 86% chance of this thing paying off. Now, remember when we were in class, we talked about the odds. We talked about the odds of these markets paying off, right? It was going to either be, you know, blackjack was like 55% versus 50%. So we were at like 50% and the house had like 55%. They have that. And we were looking at that, and that's if you're playing blackjack or if you're playing roulette. It was like 50%, 55% to the house. So they have the 5% over the, and we're sitting there playing blackjack with a 50% odds of being able to win, right? But look at this. This is an option strategy that you can play over here where they're going to give you $947 against your $666 insurance policy, and you're going to get an 11% return in 49 days. Most people would wait 2 years to get an 11% return. So is it risky? Yes, risky. Why do you think they're going to give you an 11% return in 50 years? Because in 49 days, because it's a little bit risky. But look at the probabilities. The probabilities are 86% that you're going to get this thing paid off at your 11%. You're going to get your $280. 86%. 86% chance this thing's going to make you money. That's where I was pointing out to you that, hey, blackjack's 50-50, base 50-55. This thing, you got an 80% chance of making that money, and it's 11% return, something some people would wait 2 years to get, and then you're going to receive $280 against a margin requirement of $2,500. So if you had a $5,000 account, you could do this and have an 80% chance of making that money. Pretty cool, right? All right, let's cancel that one. We could put it on. I just didn't want to. I wanted to do this other one instead. I would rather do the wheel strategy. That's not the wheel strategy. I call that the chicken wing. All right. That's called the chicken wing strategy. So if you go to the videos and look in the past, that's a chicken wing strategy. It's half a leg of a iron condor. It's one side of an iron condor. If you put on the other side, the call side, that would be an iron condor. Right. And we'll talk about that in class. Today's Friday. Tonight's Friday class. All right. We're going to have class tonight. So let's come in here and we're going to sell a put down here, and we're just going to do it naked, just like we've been doing. This is back to the wheel strategy, right? So we're going to come in here, we're going to sell this. We're going to receive $189. We're on margin, so we have to have $3,387 in our account to put this on. But if the market comes down and closes, hits the purple line underneath our red line, then we're going to have to come up with $19,000 to buy 100 shares of JP Morgan. And that would be okay. Buying JP Morgan down underneath there, that'd be, you know what? That'd be a good place to be buying JP Morgan. We'd be happy with some JP Morgan down there. We could start doing covered calls. And then if that market rises, we get rich, rich, rich beyond our wildest dreams. Okay, let's go do the MAGs. MAGs, that's the Magnificent Seven. It's an ETF. And the problem with MAGs is I love owning it. And I own a bunch of this stuff. Have for a long time. But the problem is you can't trade options on it. And it really upsets me that you can't trade options on it, because I'd love to trade options on this ETF, but you can't. So deleted. All right, Microsoft. Here's Microsoft. So we already have two options on Microsoft. One 475, the other one's 271. So how far into this thing are we? Let's go look at our positions. We're down $9 on one. We're down 15. We're not actually, you know what? It says we're down, shows a loss, but that's only if we liquidated it right now. Would we have to give back $9? We'd lose $9. They've taken out more than what they've given us, right? Remember, we got our T-square. We got 271 on one side, 271 on the other side, and we're down $9. So if we liquidated this, we'd have to give back $9 along with our 271. But we're not going to liquidate it. Time is our friend. We're going to go ahead and we're going to let this thing decay. We don't care what it tells us that our loss is, because that doesn't pertain to us. This loss does not pertain to us. It's only a number that pertains to us if we decide to liquidate the position. And we don't want to liquidate the position. We're not going to take these off. We're never going to liquidate these positions. All right. What we're going to do is we're going to wait until that thing comes all the way to there, and then we're going to take the shares. because we want to own Microsoft. If we didn't want to own Microsoft at these levels, we would not put these on there. Therefore, those numbers do not pertain to you. You don't care about those losses. They're irrelevant. Irrelevant. Let's go into our positions. Chart shows a loss. Those losses do not pertain to you because you would never have put these orders on there if you didn't want to own the shares. Therefore, those losses will never pertain to you because you're not going to liquidate halfway through the purchase. So the only thing that pertains to you is this number right here, 475, 271. Those numbers, those pertain to you. And it's right here, cost basis, 746, 746. That's your number. That's the number that pertains to you. You're going to get $746 regardless of what this number over here means. This is the part about doing this strategy that always scares everybody. Everybody's freaking out because they're like, oh no, I'm losing $21. No, you're not. You're not losing anything. The market's going to have to completely decay all the way down to here, clear down there. And if it does, it's going to give you the shares, which is what you want anyway. And that loss is going to go away, poof, into the ether. And you don't ever realize that loss. And so this is the part that freaks people out about this strategy, is because they keep looking at this loss right here and they're going, oh no. That has to take place. That loss has to take place for you to collect the $746. This is the number that pertains to you over here, not this number, because you got if, then, else. If I purchase this option and the market comes down to here, I will collect the premium of $475 and I will get my options. If I bail out early, if I decide I don't want the shares and I bail out early, that's when that number pertains to you. Only if you decide to bail out early. Okay? Don't bail out early. Just don't bail out early. Now, if the market rises, it'll show that you're making profit, maybe $200 or something. And you say, I want to bail out early. Take the $200. Okay, well, do that if you want to. But that number doesn't pertain to you. You could make the 475 if you just wait like you started in the first place. Okay, that's how this works. That's how it works. That loss does not pertain to you unless you bail out early. Okay, so we got two options in there. We're just waiting for the market to come down so we can buy our shares. We want some Microsoft shares down here. And if Microsoft doesn't come down and give us the shares that we want, well, they're going to have to pay us 746 buckaroos. All right. So here's NVIDIA. We talked about that one. Procter & Gamble. Do we want to buy some Procter & Gamble? Sure. Procter & Gamble. Now remember, Procter & Gamble pays a dividend. So we want to get into this nice dividend paying stock. Let's buy some. And we're going to come down here to 49 days. Gets monotonous after a while, doesn't it? Man, Lan, you're going to buy another one? Yeah, I'm going to make some more money. I'm going to make some more money. Okay, I guess if you want to make some more money, go ahead, make some more money. How much do you want to make, Lan? Well, I want to make $150. There's $150 right there. If they don't give me my shares, they're going to have to give me $150. And I just say to the market, whichever you prefer, I don't care. You can either sell me some shares at that price or you can give me $150. Which would you prefer? And the market's going to think about it for about 51 days. Well, can't decide. Do I want to give Lan 100 shares at that price, or should I just give him $150 and not give him the shares at that price? Let's see. Can't decide. I'll wait another day and see what I want to do. All right. So we're going to go ahead. We're going to bid on this thing. We're only going to do one. $16,000 worth of shares is what we'd be buying if they decided to drop the market down and give us our shares down in here. All right. Otherwise, if the market doesn't come down there, they're going to have to give us $150. Okay, I guess I'll take the $150. So we're going to go in here, $150, and we're going to bid for this thing because they want us to do that, to offer us the $150. They want to take $3 out. Let's go look at the options chain. Oh, Open interest is big, but volume sucks. But the spread's not bad. It's only $7 spread against $150, 0.5%. So what would we do? We would go to the pig auction and we would bid for it. I only want to give you midpoint 150. Let's put it right on the midpoint. That's $4. I only want to give you $4. Place order. And they're going to say, no, Lan. No, 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 no. Not going to do it. You're not within the boundaries of what my programming says I can do. So you're going to come down. Let's go down to 149, $5. Give it to me? No, 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 no. If you don't want to click on this little icon right here, and let's say that maybe you're not using track and trade and it doesn't have this really cool feature of dragging and dropping and you're dealing with you have to come over here to your orders. You could just right click on your orders and say edit order and it does the same thing. All right. You can just do it down here. Now we're going to come down here and you can go 6. I'll give you $6. Okay. You going to take it? No. How do I know if they take it? Well, in track and trade, because it fills that little icon right there. That little triangle will turn, in this case, it'll turn purple because it's a put option. Oh, it filled it. Look at that. Market moved enough that it gave it to us. All right, we got our fill. See how it turned purple? If it was a call option, it would turn kind of a pretty blue color. But so that's filled. It gave it to us. All right, we got $1 better. We went to the pig auction and we got our auction. Okay, we got our pig. So they gave us $148. That's our money. You can go buy something with it. Go spend it. It's yours. Go spend it. Okay, you just made $148. Okay, so let's come over here. Let's go to SCHD. What do we want to do here? Schwab. Oh, we can't do this one either. I don't think there's any options on it. This is just a dividend paying ETF. And look at how rotten that's 21 days. Let's go out a little farther. I'd like to play. This would be nice if you could trade options on this, but because it's got really high dividends, it's got really good dividends, which is why you just want to own it. But there's no volume on the options, so you can't play options against it. They know that. They're it's sad. I'd love to be able to play options against some of these really high-paying dividends. So you have to go to the stocks that pay dividends and play against them instead. Okay, well, we'll do that then. All right, this is the SPY, and I think this is the one, yep, we got our leap on. So we're doing a covered call on this one. So that's why we're up $2,000. See, that's like owning the shares. This is the NAV. Okay, so we got to go to chart. Oh, wait a second. How come that's not showing up? There we go. Chart. There we go. So 2,275. That's the NAV. That's the increase in value when we bought that option. Okay. And the option is going up in value. That's why we're up 2,275. And then we're selling premium against it. And we're collecting $220 here. Now, if this market, because it's a covered call, right? Because it's a poor man's covered call, if the market goes above that red line right up in there, if it goes up in there, then there's a chance that we could lose this option. Or lose this covered call, not the option. They'll give us the 220, but at the end they'll take away and we're doing 2 of them, so they'll take away our option, and we're like, we don't want them to take away our option, because then we have to buy it again, and then we have to pay that lousy rotten spread again. But of course, if they did take it away, we'd have $2,300, and so that's not such a bad thing. And if you think the S&P is going to fall, you might not want to have a long call on it anyway. So if they took it away, then you might be happy. So you have to take that into consideration. But that's not what we're thinking about right now. We're in this thing for the long haul, right? That's why we have 266 days on this leap option, which is got a delta of about 90. Might even be higher. Let's go look and see. What's the option? That's a 266 days. That's this one. Where is it? We can find it in our list. Where have you gone, little option? Where are you? Oh, that's the puts. You got to go to the call side. Where have you gone, little option? There you are. Look at that. We got a delta on this baby of 0.82. Oh, I thought we bought that with a higher delta. Oh, well, we got it with a delta of 0.82. So it's making 82 cents for every dollar that the underlying stock is making. That's still pretty good. That's why we're up $2,000 on this market has risen since when we bought it, right? And so that's our NAV. Plus, we're collecting premium against it because we're selling calls against it. So we're getting $220 every 21 days, which that's pretty good. That's pretty good money. I think I'd take it. But if it goes up here, then we're going to take our profits, roll it out, and we would roll it because we don't want them to actually take our option away. So we do what we call roll. We come in here, right click on this thing, and we come down and we say roll the option, and we can roll it up. We can roll it down, we can roll it out, we can roll it up and down, up and out. So that's what we probably want to do. We want to roll it up and then we want to roll it out. Up and out. It's kind of like, come on, doggy. It's like we're herding cattle. Roll them up, roll them out, roll them up, roll them out. Sounds like a song. All right, so we're in good shape over there on the S&P 500. We're making all kinds of money hand over fist, getting rich, rich, rich beyond our wildest dreams. SVOL, that's a whole lesson in itself. I'd have to spend an entire hour to teach you SVOL, so we're going to skip over that one and see how we're doing with Walmart. Walmart, we're in the same situation as IBM. We're waiting for a pullback, an opportunity for this thing to go into the green so we can start setting this thing up for covered calls. We could say, we could do it. We could do it, guys. We could come in here and say, well, if you'll come down here, we'll buy some Apple, or we'll buy some Walmart, sell a put down here. If you'll come all the way down, that's only $16, $23. Well, that's because Apple's only trading at $75 a share. So it's not very much money. I mean, it's, percentage wise, it's the same, but you're going to have a wide spread. Still going to have to pay $3, $4, $5, $3 on the spread. That's not bad. But I want to buy, I don't want to just look, you can, if you want to buy 100 shares of Walmart at that price somewhere in the next 49 days, they'll give you $111. But I don't want to do that. I want to wait for this thing to already pull back. I want to see it pull back, give me a nice little pullback against the Fibonacci sweet spot, go in there. I'd be more likely to want to buy when it's down here. But if I go in there and say, well, put your order in there, sell a put in there, it's only $63. But I don't really want to buy down there. Well, $63, and you're going to get your shares. Let's put it at 61.8, right on the 61.8. That's only $36. And you're going to have to pay $2 in, $2 out. So roughly you're going to make $30, and then they're going to assign you the shares if it falls below there, and you're going to make $7,000, or have to come up with $7,200 to buy some Walmart to make $36. But that $7,000, we got $61,000 of buying power. We could do 2 or 3 of them, but then we'd have to buy 200 or 300 shares of Walmart. And is that what we want to do? Well, Walmart's still going up. I don't know. See, if you don't know what to do, don't do anything. Just wait till a better opportunity. Go find something where it's easier, more easy to make that decision. It's only $37. It's like, why bother? But because you're going to get the shares. Well, I can buy the shares and not worry about the $37. Yeah, but you're going to get $37. $37 better than nothing. And you're going to buy the shares anyway if it goes down there. I know. I just hate trading this strategy on markets that have such tiny little share prices. $72 is $37. $37. Yeah, but it's $37. And you want to buy the shares anyway. I know. I think I'm going to wait on that one. I'm going to wait until that chalk and money flow goes green. I want to see it go green. Then I'll start buying Walmart. Then I'll start putting my options orders in there. We'll start picking up some Walmart. We need a lot of Walmart because it's trading at $69 a share. So we need a lot to make it worthwhile. But we can afford a lot. So that would be okay. And it's fun to do that because then you can start breaking them apart and do them at different levels. And that's fun too. All right, guys. I think we've kind of spanked the monkey good today. ExxonMobil. That's a nice one right there. I think that's a juicy one. We might be able to do something with Exxon. All right, here we go. Let's come in here and sell a put down here. See if we want to buy some. $100, $200 to buy some ExxonMobil at their lows. Let's do that. Let's just do one. Yeah, all of these, we're just doing one. We're just keeping it simple, right? And you don't have to do all of them like I'm doing in here. This is if you have a $150,000 account. If you're going to trade, if you've only got a $50,000 account or a $20,000 account or a $5,000 account, just pick one. Just start. Just start. Just start. Just do one. Just do one. We're going to place our order in here. Is it going to go? No. Why? Because we're not inside the bid-ask spread. Okay, they want 221. We're offering 223. Let's offer them 222. See if they take it. No. Edit. Our volume and open interest is plenty good. Volume is 129. Open interest is 5,000. We're going to go in 221. This would be a good one. If you're going to only do one, you're like, Lan, I don't know about this. Scary. Just do one. Just do this one. Just do ExxonMobil. This would be a good one. Why is ExxonMobil good? Well, because look at how dead it is. I mean, it just goes back and forth, back and forth, back and forth. Pays a good dividend. So when you own it, you're going to get a good dividend on your shares. And it just goes back and forth. So it's not a big risk one way or the other. And you're selling premium, so it's got to come down here. You get your shares. It's not like it's going to tank and go all the way to zero. Of course, if Trump gets in. All right. Why didn't that fill? Let's place it again. If it doesn't fill, delete it, place it again. Sell the put. 220, we're going to take it right there. 220, we're going to go to the 217. Place the order. There it goes. It filled that time. All right. We just made $217 over the next 49 days. And of course, we've agreed to buy the shares if they don't give us the $217. But we want to buy the shares anyway. We want to buy the shares. It'd be $11,000 worth of shares on the ExxonMobil. Now, if you don't have 11,000 shares, don't do this one. If you don't have $11,000 to buy the shares, don't do this one. I know it's $100. Go do something that's cheaper. Go do Walmart. It's less money. There we go. All right, guys. I got a Sunday school lesson for you. Don't revenge trade. If you lose, don't try and win it all back in a single trade. Don't try and win it all back today. All right. If you lose, don't worry about it. You'll make it somewhere else. We got to diversify. If the only thing you're doing is day trading, you got to be careful. So today we got our hiney handed to us on day trading, $685. That's all right. Tomorrow we'll come back and get it back tomorrow or this afternoon when things calm down and aren't so jumpy like in the first thing in the morning. I don't like to really trade real first thing in the morning. That's why I teach these classes first thing in the morning, because I'm not trading real money. I don't trade real money in the first thing in the morning. I wait for the first hour or two to go by, and then I like to start trading. I like to start trading at the top of the hour. It's easier. Seem to find better opportunities. Market's not so crazy and jumpy. So $685 down, not big deal. But don't get revenge trade. Don't feel like you have to get it back today. Don't feel like you have to get it back tomorrow. Don't feel like you have to get it all back at once, right? Don't feel like you have to get it all back at, I know you get that feeling like you want to get it all back. Just don't go playing that feeling. Don't fall to the prey of that feeling. Don't revenge trade. You'll get it back. And the best thing to do is to be diversified. So if you're not doing too well today on your day trades, if your day trades went badly, like today for us, down $685, that's okay. We're doing really well over in our stock market version, right? In the stocks, we're kicking butt. So that's why you want to do more than just one thing. You want to take the money from day trading when you make it, put it over into the stock market, trade some of these option strategies. It's a little bit safer. And if you don't want to day trade, don't day trade. Just come and trade options. That's okay too. Nothing wrong with that. All right. And you don't want to trade options? Don't do that. Just go buy some high dividend. ETFs. Here's a really good one. It's right there. SCHD. See that? The D stands for dividends. That's a really good dividends ETF. It's very well diversified. If all you want to do is be really super conservative and you're going to hold your money for at least 5 years, just throw it in there. I got a whole bunch of money in this market, SCHD. Then it just keeps trucking up and it makes more money with the dividends. SCHD, it outperforms the S&P. If you're not familiar with it, Go get Pit News Magazine. We got a whole big article written up on SCHD in Pit News Magazine. I think it was in the current issue, wasn't it? Did we talk about SCHD? I know we wrote the article. Whether it might be coming out in the next article, in the next version. So we got a whole write up on SCHD, I think. Yeah, coming up in Pit News Magazine, and it'll tell you all about it. Plus, it's got a companion called SCHG with a G with a growth. So you have SCHG and you have SCHD, and they're two really super good ETFs. And so if you want to be super conservative, just put your money in there. Put your money in the growth and in the dividend version, split it based on your age. If you're 60, put 60% in D and put 40% in G. And that's all you have to do. Do that and walk away. You don't have to do anything else. Just do that. But if you want to make a whole lot more, then come and do what we're doing here. Play with the options. Sell some premium. Collect premium. Buy long calls. Make money when the market goes up. Buy puts. Make money when the market goes down. All right. And then day trade. Day trade, because that's fun too. We like that. We like day trading. All right. Guess I'll let you guys go. I guess we never did get back to the Trade Miner Pro, did we? Trade Miner Pro. That's okay, though, because I just wanted to show you that some of these that we didn't choose are making money anyway. Look at that, 479, 448. This one lost 137. But these were some that were in our list, but we never did pick them. The AI system picked others instead. So that's the neural network. And then we get into the search, and we didn't do any new searches. But that's okay, because there wasn't a whole lot to search on, because we're starting a new month here coming pretty soon. We'll do that next week. All right? And that's Trade Miner. That's how we ended the day. If you guys had fun today, go ahead and hit that little thumbs up. I know it's a long day, but we covered a lot of ground. Good lesson. And tonight, for those of you who are in the class, we'll see you tonight when we'll review the next step and what we're going to do next. All right? So we got one more level, one more class. We're going to start talking a little bit about some of these other strategies. I want to talk to you about straddles, strangles, and chicken wings, and iron condors and iron butterflies. And that's what's on the agenda for next week as well. We'll follow through with the class tonight and then go through with the lab next week. And we'll just continue making money. That's what we do in this channel. Okay. So we're going to go in here, and what we do is we do lots of things in the demo account, and then we pick our favorite ones out of the demo account and we put them in our real money account. Sit and do all these in the demo account, and then we pick our favorite one or two and we put them in the real money account. All right. That's how you do it. So come and join me, stick with me, and we'll just make this happen for you too. We'll see you later.